Hello everyone, welcome to EduTap and welcome to today's session. So today we are going to discuss the Financial Stability Report, which is one of the most important report of the Reserve Bank of India. In the recent RBI Grade B examination, you have seen that direct questions have come from the FSR report. Okay, so this is the 28th issue of the FSR that has been released by the Reserve Bank of India recently only, that you can see. And today we are going to cover this very important report, that is the Financial Stability Report of the Reserve Bank of India. So today we are going to cover the highlights of this report. Okay, so let's get started, and do tell me that I am audible and visible clearly. Give me a thumbs up. Am I audible and visible clearly? So today we are going to cover the highlights of this report, which are very important. Okay, so good morning Dipanshu, good morning Gomti. So good to see Gomti in the morning, also in the ESI class, and now also. So nice. So today we will be covering the Financial Stability Report. Give me a thumbs up if I am audible and visible clearly. Do subscribe to the YouTube channel and join our Telegram channel for the PDF of this session. Okay, so you will get the PDF of the session in the Telegram channel, and the link for the Telegram channel is given in the description box below. So starting with the Financial Stability Report, first of all you have to understand that this is the half yearly publication of the Reserve Bank of India. That means this is released in the 6-month period. Okay, so the report on trend and progress, that is a yearly report. The annual report of RBI, that is a yearly report. But the FSR, that is the Financial Stability Report, that is a half yearly publication of the Reserve Bank of India. It is a half yearly report of the Reserve Bank of India, but it is one of the most important reports of the RBI. Now this FSR, it is a collective assessment of the subcommittee of the Financial Stability and Development Council. So the FSR is the collective assessment of the subcommittee of the FSDC. So who knows that if we talk about not the subcommittee but the FSDC in total, who is the chairman of the Financial Stability and Development Council? Anyone knows who is the chairman of the Financial Stability and Development Council? So it is the Union Minister of Finance, who is the chairman of the FSDC. Okay, so it is the Finance Minister who is the chairman of the FSDC, and the FSDC, it includes the regulators of all the sectors, the PFRDA, the Reserve Bank of India, the SEBI, all the regulators of the regulatory institutions are the member of the FSDC. Okay, now there is the subcommittee of FSDC. There is the subcommittee of FSDC. In this subcommittee, who is the chairman of this subcommittee? The Governor of the Reserve Bank of India. The Governor of the Reserve Bank of India is the chairman of the subcommittee of the FSDC. So I hope you will remember this very carefully, that the FSDC, the chairman of this is the Finance Minister, and then there is the subcommittee of the FSDC. The chairman of the subcommittee is the Governor of the Reserve Bank of India. Okay, now this subcommittee of the FSDC, it provides a collective assessment in the FSR with inputs from all the financial sector regulators. So the FSR, it reflects a collective assessment of the subcommittee of FSDC with inputs from all the financial sector regulators. Let it be SEBI, let it be PFRDA, let it be the IRDAI. Okay, it shows the assessment and evaluation of the subcommittee of the FSDC on the risk to the financial stability. What are the risks that are coming to the financial stability, and the resilience of the financial system. How resilient the financial system is, how resilient the banks are, how resilient the NBFCs are, how resilient the urban cooperative banks are. Okay, FSR consists of 3 chapters: the macro financial risk, the financial institution soundness and resilience, and regulatory initiatives in the financial sector. So you can understand that the first chapter talks about the macro financial risk. What are the financial risk of the whole of the country, of the whole of the financial segment? Macro means the large segment of the country, the whole country economy as a whole. So what is the financial risk that are coming in the economy as a whole, or what are the financial risks that are coming in the financial segment of the country? Then the second chapter talks about the financial institutions soundness and resilience, that how resilient the banks, NBFCs are, how resilient the urban cooperative banks and others are. Regulatory initiatives in the financial sector is the third chapter, in which we discuss all the initiatives that have been taken by the different regulators in the period of the last 6 months. Okay, so what are the regulatory initiatives that have been taken in the financial sector by RBI, SEBI, IRDAI, and such. Then there are the 3 chapters, as well as in the FSR there is also a systemic risk survey in which a survey is conducted, and as per that there is the whole survey that comes out that okay, this risk is the maximum in our country, this risk has reduced in our country, and such. So this is the whole of the idea of the financial stability report that I hope you have already understood. Okay, so is it clear? I hope this is very much clear. No confusion should come in this. This is the basic structure of the FSR that is released. So now the RBI has released the 28th issue of the Financial Stability Report. So 28th issue of the FSR has been released by the Reserve Bank of India in December 2023. Okay. So now coming to the highlights. Now we are going to discuss the very important highlights of the report. So starting with the highlights, the global economy has faced multiple challenges and it is continuously facing multiple challenges. Prospects of slowing growth. So there is the slowing growth that is faced by the global economy. Large public debt in the underdeveloped countries. In the developing countries, there is large public debt that is accumulative. Even in the some of the developed countries also, there is the large public debt that is accumulating. So that is a very problematic situation that is happening. Increasing economic fragmentation because of the Russia-Ukraine war, because of the geopolitical turmoil that is going on around the world. There is the economic fragmentation that is happening. Some countries are supporting a particular organization, some country are supporting some other country or such. So there is the economic fragmentation that is happening. Prolonging geopolitical conflicts. So Russia-Ukraine war was there. Now there is a new problem that has started in the geopolitical space. So you can understand that there are many of the turmoils that are coming in the global economy. Okay. The Indian economy and the domestic financial system has remained resilient. Even when there was the Russia-Ukraine war, even when there was the COVID situation, yes, we had a little trouble when it came to the medical services and all, but the country was able to surpass that. The financial system of our country was very well working. There is no bank that has fallen down in that time during the Russia-Ukraine war or during the COVID situation in our country. The banks remained resilient. The NBFCs remained resilient. They themselves started to maintain higher CRAR, that is higher buffer capital. The banks and the NBFCs started to maintain. So they remained resilient. Okay. Supported by strong macroeconomic fundamentals. We had very strong macroeconomic fundamentals. We have such a huge country that our demand, even in the worst of the times, our demand was resilient. It was not falling much. And due to that, the production was not affected to the greatest of the extent. It was affected during the lockdown, but before that, after that, it remained good. Okay. Healthy balance sheets have been maintained by the financial institutions, by the banks, by the NBFCs, moderating inflation. The Reserve Bank of India is continuously looking after the inflation, is continuously trying to moderate the inflation, trying to bring the inflation below 6%. Improving external sector position. So our external sector position is also improving. Our exports have actually improved in the last few months. Continuing fiscal consolidation. Fiscal consolidation, that means that the fiscal deficit, we are trying to reduce our fiscal deficit. So someone is asking about economic fragmentation. What happens that some countries that are supporting Russia or that are not against Russia, and there are some countries that are supporting Ukraine. So there is the fragmentation that is happening between the countries. Okay, the countries that are supporting Ukraine, like it has been said by US and UK that do not purchase oil from Russia. So that is the economic fragmentation, that in the economic sense, the countries are diverging. Okay, the countries are fragmenting. They are not following the path of the maximum benefit. Okay. Now fiscal consolidation means, continuing fiscal consolidation means reduce the fiscal deficit. Reduce the fiscal deficit means reduce the borrowing requirement. Okay, reduce the borrowing by the government. So fiscal deficit, I hope you know the formula. Fiscal deficit is equal to the total expenditure of the government minus the total receipts of the government excluding the borrowing. So total expenditure, when the government's expenditure is greater than the total receipts of the government excluding borrowing. So let's say total receipts of the government excluding borrowing is 80. That means fiscal deficit is 20 rupees. Fiscal deficit is 20 rupees. That means this much has to be borrowed, because here we were excluding the borrowing. That means 20 rupees has to be borrowed. So when the fiscal deficit is reducing, that means the borrowing requirement of the government will reduce, and that is a good situation. Okay, so I hope you have understood this. External sector means, external means what? Out of our country. As easy as that. Okay, external means out of our country. We are a country. Out of our country is external sector. So improving external sector position means that our position in terms of the rest of the world is improving. That means we are able to export. Okay, we are getting back on our feet in terms of exporting. So this is the global growth forecast for the 2023 that has been given by the IMF and the World Bank and OECD and such. So the IMF has said that the International Monetary Fund has projected that the global growth would decline to 3%, in 2023 and 2.9% in 2024. That was below the pre-pandemic level on average of 3.8%. So pre-pandemic level on average was 3.8%, that the global economy was growing by approx 3.8% before the pandemic situation in 2000 to 2019 period. In this period, on average, the global economy every year was growing by 3.8%. And now the IMF has said that the projected growth rate for the global economy is 3% for 2023 and 2.9% for 2024. And that is not a very good growth that the global economy is seeing right now. Okay. So I hope you have understood. So this is the 3% mark that the IMF has recently said in its World Economic Outlook report that has been released by the IMF. Okay, report that has been released by the IMF. So it has said that in 2023 the world global economy is going to grow by 3% for 2023. Okay, for 2024 2.9%. These are some of the important percentages that you have to remember. I will all your queries that are not related to FSR, I will cater to at the end of the session. Now the capital to risk weighted asset ratio, that is the CRAR. Now first of all, I hope you remember that what is CRAR. So CRAR, it is the capital to risk weighted asset ratio. Okay, capital to risk weighted asset ratio means risk weighted asset means what? Asset is the loan that the banks are giving to the people. Okay, so on the loans the banks are earning interest. So these loans are the asset for the banks. Okay, now on these assets, on these loans, there are some risk. If the asset or the loan is given to companies, 10% risk, MSMEs 15% risk. If there is the loan that is given to retail individual, maybe 5% risk. So there are the risks that are attached with the assets and that are weighted, and as per the risk weighted assets, the banks have to keep some capital. Okay, that is 9% of the capital to risk weighted asset the banks have to keep. That means out of the 100 rupees of the risk weighted asset, the banks have to keep 9 rupees as capital with themselves, plus 2.5% of the capital conservation buffer has to be maintained by the banks. So I hope you have understood. CRAR is 9% plus 2.5% is the capital conservation buffer. So the banks have to maintain 9% of the capital against the risk weighted assets. So now in this 9% there is the division between tier 1 capital and the tier 2 capital. Tier 1 capital is the liquid kind of capital that the banks can use in the distress kind of situation when the bank are not in a healthy position. Okay, so tier 1 is again divided in the common equity tier 1, that is the most liquid kind of capital that the banks can have. And then there is the AT1 capital, that is a kind of bonds that the banks can release when they are in a very bad situation. Okay, they are in the distress kind of situation. So CET1, the 5.5% of the CET1 has to be maintained by the banks. This is the minimum. AT1, 1.5% of the AT1 they can release the capital they can have. Tier 2 is the capital that is the bank can have when the bank is selling its asset, its property, its institution and such. So this is the capital that is for the last resort. Last resort kind of capital is tier 2 capital, that is okay here, that is 2%. So 5.5%, 1.5%, 7%, 8, 9. So in total 9% of the CRAR or capital adequacy ratio. Plus 2.5% is for the capital conservation buffer. Okay, so this is the CRAR, that is the capital to risk weighted asset ratio, that how much capital the banks are keeping with themselves against the risk weighted asset. The higher capital they are keeping with themselves in the healthy manner, the more they are safe from the risk assets. Okay, and the common equity tier 1, I have told you, common equity tier 1 is the most liquid kind of capital that the banks can keep under the CRAR to come out of the distress situation. Okay, so this is the most liquid kind of capital. So the scheduled commercial banks, they were maintaining 16.8% of the CRAR in September 2023. That is way above the 11.5%. So the CRAR, minimum CRAR is 9%, that is mandated by RBI, plus 2.5% is the capital conservation buffer. So 11.5% minimum the bank should be keeping with themselves. So the banks were actually keeping 16.8% CRAR in September 2023. That is a very, very good percentage. Okay. Now the banks, they have to keep 5.5% of the common equity tier 1 capital, but they were actually maintaining 13.7% of the CET1 capital, the most liquid kind of capital that can take the banks out of any distress situation. So remember these percentages, that in September 2023, the CRAR was 16.8% that the scheduled commercial banks were maintaining, and the CET1 capital was 13.7% that the banks were maintaining. Okay, so 16.8% September 2023 CRAR. Okay, now in the previous class there was a minor confusion that happened, so let me clarify it here. Like I have told you that as per the report on trend and progress of the banking in India, in this report also in the highlights it was given that the scheduled commercial banks are maintaining the CRAR of 16.8% in September 2023, and this has become a very important percentage. It is mentioned in the FSR, you can see it is mentioned in the report on trend and progress of banking in India. So you have to remember that the CRAR maintained by scheduled commercial banks in September 2023 was 16.8%, 13.7% was the CET1 in 2023 September. Okay. Now this was the data from the report on trend and progress. This was for at end March. Now I skipped this part, so that's why there was the problem that was created. So in 2022 March, the banks were keeping, scheduled commercial banks were keeping 16.8%. In 2023 March, the banks were keeping 17.3%. Scheduled commercial banks were keeping 17.3% of CRAR. And in September 2023, again, the banks started maintaining 16.8% of CRAR. So now I think everything is clear. Now coming to the next highlight, that is regarding the scheduled commercial banks gross non-performing assets. Now when the bank is giving asset, that is when the bank is giving loans, some of these loans can come into the non-performing assets. That means these loans are not coming back. The interest on these loans are not coming back. So this is the problem that can be created. Now everything is clear? Before tell me about this. Clear now? March 2022, 16.8%. March 2023, 17.3%. September 2023, 16.8% of the CRAR. Okay. See, CCB is the capital conservation buffer. CYCB is the counter-cyclical capital buffer. Okay, counter-cyclical capital buffer. So these counter-cyclical capital buffer, it is like very rarely that the RBI uses it. The RBI only uses the CCB for now. Okay, so CRAR is 9%. The CCB, that is the capital conservation buffer, is 2.5%. CCYB only RBI uses it when the RBI thinks that the production has dropped to a great extent, which has not happened in our country. That's why CCYCB is not being used. Okay. Chalo. Now coming to the scheduled commercial banks gross non-performing asset ratio. So some of the loans, they can become non-performing asset. That means they are not coming back. The loan is not being paid. The interest payment are not being paid by the people. Okay, by the person, by the company or such. So gross non-performing asset ratio continued to decline. So this is a very good thing that has happened, that the non-performing assets, the gross non-performing assets, they are actually declining to a multi-year low of 3.2% in the September 2023. So that is, it is nearly 10-year low that the gross non-performing asset ratio has declined to 3.2% in September 2023, and the net non-performing asset has declined to 0.8% in September 2023. So here you can clearly see that in September 2023 the gross non-performing asset has declined to 3.2%, and in September 2023 the net non-performing asset has declined to 0.8%. Okay. Now coming to the provisioning coverage ratio. Now there are the loans that are becoming NPA, non-performing asset. Okay. For these non-performing assets, how much provision the banks are keeping with themselves? That is the provisioning coverage ratio. That to cover the non-performing assets, how much provisioning the banks are keeping with themselves. So the higher the provisioning is, the better it is. Okay, because the better provisions the bank has to handle the non-performing assets. So the provisioning coverage ratio that is being kept by the scheduled commercial banks rose to 75.3%. So that is a good percentage that the banks are able to maintain. Okay, and it is higher than March 2023, slightly higher than March 2023. So that also you can see that for all the scheduled commercial banks, for March 2022 it was lower. In September 2022 it has increased. It has further increased in March 2023, and in September 2023 it is 75.3%. That is good percentage. Okay. Any confusion till now? Difference between the gross non-performing asset and the net non-performing asset. So gross is taking all the non-performing assets in account. In the net we deduct some that the bank is not showing in its balance sheet and such. Okay, so now yes, that could be true. Harish is saying that the gross NPA can be low because the bank has given the loans to the bad bank, that is NABARD. Okay. So Tekken Games, how many months? So that you will have to ask me in the comment section because I do not remember. It is after 91 days, I guess. Okay. See, provisioning coverage ratio, the NPAs that the bank have. How much provision the banks have to cover these NPAs? If the NPA is of 100, the banks have 75.3 rupees to cover this NPA. Okay, so the NPAs that can be created or that has been created, how much provisions the bank are keeping with themselves for those NPAs, that is the provisioning coverage ratio. So now coming to the macro stress test. So macro stress test, they attempt to access the capital ratios, the CRAR, how much CRAR the banks are maintaining over a 1-year horizon under a baseline and 2 adverse scenarios. So what happened that we want to see for the future, that in the future the banks are going to maintain the healthy capital or not. They are going to maintain the healthy capital ratios or not. So to see for the future, we take the macro stress test in 3 scenarios. There is a baseline scenario, normal scenario, there is a adverse scenario, medium adverse scenario, and severe adverse scenario. So for in these 3 categories, we see that how much the CRAR will be in the next 1 year. Okay. So in September 2023, the calculation must have happened, because we are seeing for the September 2024 that for this period of time, what will be the CRAR for the normal situation, for the medium adverse situation, and for the severe adverse situation. So you can understand that the macro stress tests happen. It must have happened in September 2023, because we have got the data for September 2024. That in September 2024, the CRAR will be what percentage in normal scenario, if the normal scenario continues, in the medium adverse scenario, that if any kind of turbulence come. So in the adverse scenario, what will be the CRAR? And then in the severe adverse scenario, that something very bad has happened. In that scenario, what will be the CRAR that the banks will be keeping? So macro stress test for the credit risk reveal that the scheduled commercial bank would be able to comply with minimum capital requirement, would be maintaining higher than the minimum capital requirement, that is the CRAR of 11.5%, with the system level CRAR in September 2024 projected at 14. In the normal scenario, 14.8% of the CRAR will be maintained by the banks. For the medium adverse scenario, the banks will be maintaining 13.5% of the CRAR in September 2024. And in the severe worst kind of situation, in the worst ever kind of situation, in the severe adverse situation, the banks will be able to maintain 12.2% of the CRAR in September 2024, which is higher than the minimum required by the Reserve Bank of India, that is 11.5%. The macro stress test for credit risk reveal that scheduled commercial bank would be able to comply with minimum capital requirements with the system level CRAR in all the banks in September 2024 projected at 14.8% in the baseline scenario, normal scenario, 13.5% in medium scenario, 12.2% in severe scenario in September 2024. So till now everything is clear? Okay. So now this is the last point that you have to understand. This was all regarding the highlights that we have discussed. So the resilience, till now we have discussed about the scheduled commercial banks. So the resilience of the non-banking financial companies sector, the NBFCs, they are also becoming very resilient. So the resilience have improved with CRAR at 27. The NBFCs, they have to maintain minimum 15% of CRAR. So the NBFCs, they have to maintain the higher CRAR as compared to banks. For the banks, the minimum is 9% plus 2.5%. For the NBFCs, the minimum is 15%. But the NBFCs are actually maintaining 27.6% of the CRAR with themselves. The capital adequacy ratio, or the capital to risk weighted asset ratio, is 27.6% for the NBFCs. Gross non-performing asset ratio is at 4.6%. Return on assets, that how much return they are getting on the assets, is 2.9%. And so this is the percentages for September 2023. So here you can see that the NBFC sector has increased its area in the financial intermediation in the financial sector, and this has been associated with their rising connectedness with the traditional banking system. They are getting connected more and more with the banking system. They both are coming together to work together. Substantial capital buffers are being maintained by the NBFCs, that you can see 27.6% of the CRAR is a very high CRAR that the NBFCs are maintaining. Their asset quality is improving. Robust earnings is also improving. That has increased the resilience of the NBFC sector. The CRAR was 27.6% in September 2023, while the minimum that they require to maintain is 15%. So more than 10% higher they are maintaining. Okay. The GNPA ratio has declined from a high of 7.2% in December 2021. So GNPA ratio for the NBFCs was 7.2% in the December 2021, which has declined to 4.6% in September 2023. Okay. NIM, that is the net interest margin. Net interest margin means that how much the interest income that the NBFCs are earning by providing the loans, by having the assets, minus the interest that they have to pay to the depositors. So interest income minus the interest that they have paid, the percentage is the net interest margin. the value is the net interest income. So interest that they are earning minus the interest that they are paying, it is the net interest income. Okay, net interest margin is actually the percentage. Okay, so net interest margin and the has stood at 5.1 percentage. 5.1 percentage of the net interest margin the NBFCs are getting, and the return on assets is 2.9 percentage for the NBFCs in September 2023. So this is a very good thing that is happening. Healthy balance sheets are being maintained by the NBFCs. They are consistently expanding their credit, which grew from 8.9 percentage in September 2021 to 20.8 percentage in September 2023. So you can understand that how big of a deal this is, that from 8.9 percentage their credit has increased to 20.8 percentage. So this is the whole highlights regarding the FSR, regarding the financial stability report. Okay, any confusion now? So this is the first question that you have to answer. The financial stability report, we will discuss it near to the examination. Okay, this is the highlights that have discussed. We have discussed the detailed session. I will see that should I bring it right now or should I bring it near to the examination, because what happens that near to the examination you will able to recall, you will able to remember, as well as the June, we will see that if after the June the examination is happening, in the June the next segment might be released of the FSR. Okay, so that's why I am waiting for that also. After that we will see that what happens, and then I will bring out the detailed session for the report on trend and progress. For this I will be bringing the detailed session very soon, because this is a yearly report, annual report, but the FSR is half annual report. So that's why half yearly report. So that's why I will see for the FSR that should we bring the detailed session now or not. But for the report on trend and progress, I will try to bring it soon. Okay. Thank you so much, Bhanu. I do want to see your mail. Okay. This is the highlights that have been provided by the Reserve Bank of India, or that I could find in the report. The full report, the detailed report of the FSR. See, usually the questions the RBI asks from the highlight directly. It happens. I have seen the previous year question, directly the RBI asks from the highlights. But in the descriptive, the details are required. So for that, I will be bringing the detailed report of the FSR near to the examination though, because the FSR next edition can also be released at that time period. Okay. No, their credit increase means from the past year. Year on year लिखा है ना यहाँ पर. Year on year means that from the, okay, NBFC's credit increased, grew from 8.9% in September 2021. That means from 2020 to 2021, NBFC's credit has increased by 8.9% as against NBFC's only. But in 2023, what happened in September 2023, NBFC's credit has increased year on year. Year on year means that from previous year, the credit of the NBFCs increased by 20.8%. So here year on year is written now. That means in itself from previous year to now. Akshay, I will say that to cover the current affairs with the static, because what happens that many of your static concepts will also be cleared with the current affairs. Now we have discussed about the CET1, we have discussed about the GNPA a little, we have discussed about the CET1, the AT1. So some of your ideas will be clear from here also. So you can continue watching both. Okay, static and current affairs. First question, and this is your second homework question. Try to give the right answer of this question. Now, I want to show you the students that have given the right answer of the previous session question. So, here, Sonali and Nand Kumar. So now there was a confusion that came here na, at this point of time. Yes, for September 2023, the CRAR is 16.8%. So in the PPT, everything was correct. Okay, here in the next slide. Yes, it was at the end of March. Okay, so for 2022 it was 16.8. For 2023 it was 17.3 at the end of March. But for September the data was 16.8. That has been clarified here also in the pinned comment. Sonali, and you are most welcome, Nandkumar. Sonali has given the right answer. Harshit has given the right answer. Happy New Year to all of you. I totally forgot. Happy New Year to all of you. Kingshuk has given the right answer. Abhiman has given the right answer. Durga has given the right answer. Ronak, Abhishek, Saurish, Abhay, user Shubham, Kandeya, Kamal, user Bhavna, Tamiz, Namrata, Harshdeep. So all of these have given the right answer. And today I try to not repeat my words. Sometimes it happens that I think that you are not able to get some of the points, so I tend to repeat some things, but I hope you are able to understand everything very clearly. Okay, so this is the whole highlights that has been provided. The PDF you will get in the Telegram channel. The link for the Telegram channel is given in the description box below. Now if you have any query, if you have any query, you can comment down below. And for ESI sessions, they are for the paid students, okay, for our gold or silver batch, and this is from 7:30 to 9:30 or 10 till it happens. Yes, okay, I will convey this to Diksha ma'am. It is live at 7:30, but it is for the ESI students. Yes, Finance 360, it is beneficial for SEBI also, but you do not have to go too much in depth. Okay, just the basic idea you need. Like for the RBI students, they do not go too much in depth in the SEBI case. Similarly, for the SEBI students, they do not have to go too much in depth. Just have the basic idea that what is going on for the NBFCs, what is the CRAR, for the banks, what is the CRAR, the minimum one, what they are maintaining. Just the basic idea. Okay, if you have more confusion, if you have more of the queries, you can comment down below. You can call us here. You can also mail us here. Okay. So Bhanu and 1 or 2 students that I was seeing that were the paid students, do mail me the feedback of the ESI session and today's session. You can also. So you can write us at hello@edutap.co.in. So this is our number. This is our mail ID. Thank you very much and have a very good day. Okay. I will take more of your queries in the comment section. This year in interview, your sessions really helped me, ma'am. Thank you. I followed you rigorously for RBI 2023. Just missed final cutoff. I'm so grateful for you, Sid, for saying this, and thank you so much. It means a lot. Okay, it means a lot, and I hope that you are able to clear the RBI grade B in this year. Okay, Akshay. Okay, Akshay. Then it is in the ESI, in the RBI grade B. There are the phase 2 classes that are going on. So for phase 2, you can start the ESI sessions. They have started from 30th December. Okay. You can also mail at hello@edutap.co.in that you are not able to find the sessions. Okay, everyone. Thank you very much and have a good day. See you again in the next session and have a good day, everyone. You're most welcome, Sid, and you are most welcome, everyone. So I will be closing this session now.